So today the chapter is investment appraisal. The first thing is we need to know what is meant by an investment. Investment means where we use our money to make more money, right? And there are different places where we can invest: bank, stock market, government, treasury bills, treasury bonds, or in a business. And the risk and return, when the risk is high, return is also high. When the risk is low, return is also low. Right. So let's write the next point. Number 4. Investment appraisal methods. Investment appraisal methods. We can use different methods to uh, see the investment risk and return. Right. So methods, and remember this is a very simple chapter, right? Easily you can get the marks if you understand the techniques. We will learn payback period, payback period, right? Then investment rate of return, investment rate of return. Investment rate of return, right? There are 4 methods. Then net present value, net present present value. Finally, internal rate of return. Internal rate of return. So mostly you get questions from NPV. NPV is the most common method. Right, so these are the four important methods. Okay. Right. Now let's learn one by one. And these two methods, this also we will try. First two methods. We don't consider the time value of money. Do not consider time value of money. And the other two methods, consider the time value of money. Do not consider and consider time value of money. So if you can do all these four methods, that is more than enough. Right? You can get at least 10 marks out of this. Right. So let's start with payback period and counting or investment rate of return. Investment rate of return means we call it accounting rate of return as well. Okay. Write the heading investment rate of return. Number one, investment rate of return or accounting rate of return. So what is the internal rate of return? I will explain one by one. I'll explain. Okay. I will explain one by one. Okay. First, investment rate of return. So in this method, what we calculate is what is the return for the investment. If you, let's say we invest, say we invest 100,000 and we are getting a profit of 20,000. What is the return on investment? How much is the return on investment? Tell me. Avindu, Shima, Shant, 20%, right? Return on investment means you have to find out the percentage, right? 20,000 divided by investment into 100%. So that is what we learn from investment rate of return. Very simple, right? 20%, correct. So we can write under investment of return, investment rate of return. This method means the rate of return, highlight for the investment, rate of return for the investment. And there is an equation for this. The equation is accounting rate of return equals average net profit after tax divided by average investment. Let's write this equation. Average net profit after tax divided by average investment. Accounting rate of return. Then there are two things. What is mean by average net profit after tax? What is mean by average investment? Average net profit means, let's say we are calculating for 5 years. Average net profit means total of 5 years divided by 5. Right? So we calculate the average. The two equation as well. Average net profit is equals to total of the profit after tax during the lifetime of the investment. So let's say we are preparing for 5 years. So you add 5 years profits and divide by number of years. Number of years means 5. Average investment means initial investment plus value of investment of the end divided by 2. Okay, so write this equation. Then let's do example 1. So I'm going to do example. Sometimes you will get only the opening balance. Then what you have to do is divide it by 2. Initial investment is 200,000. It is estimated that at the end of the period, end of the period, example 1. Initial investment is 200,000. It is estimated that end of the 3 period, the value of investment will be 80,000. And they have given the profit for the 3 period. Profit for the 3 period. Here 1, 1, 2, 3. 100,000, 120,000, 8,000. Right. Calculate the investment rate of return. Calculate the accounting rate of return. Example. So I'll give 3 minutes. Now calculate the investment rate of return. Just apply for this equation. Get the average profit and average investment. Very simple. Average net profit. What is the answer? I didn't get the answer. I got only one answer. 70. That's correct. How about others? Correct. Sanova, what is the answer? Like, what is the answer? Average net profit. Average net profit means now we have 3 years profits. There is a question. So all these methods are used to calculate the rate of return from investment. Now, different methods, all these methods used in order to find out the return, whether the projects are profitable or not, favorable or not. Okay. So here, average net profit. So there are 3 years. Total net profit is 300,000. Divide by 3. So average net profit is 100,000. Divide by average investment. Average investment. 200,000 at the beginning plus 80,000 at the end. 280 divide by 2. 280 divide by 2. So 280 divided by 2 is 140. Therefore, return rate of return is 71.43. 71.43. That's the rate of return. Investment rate of return is 71.43. I will check your answer, Nikesh, here. Okay. Right. So this is very simple. There is a question in which part we get this type of question. You get in the second paper. I'll show you. We will do the past papers. Right? Second part. You get this in second part. Yeah, correct. Okay, now the second point is second method. Number 2 is payback period. Is this clear for everyone? Very simple. Average profit divided by average investment. So you get what is the return on your investment. We are going to the second. Number 2, payback period. Payback period. So what is payback period? Let's say now I have 100,000 rupees. My investment is 100,000 rupees. Right? Or I'm going to buy a machine. A machinery. Now from this machinery, my first year cash inflow, my cash inflow, year 1, I'm getting 60,000. And year 2, I'm getting 40,000. Year 3, I'm getting 20,000. This is my payback period. Payback period. I had 100,000. I invest 100,000 to purchase a machinery. And in year 1, I'm getting 60,000. Year 2, I'm getting 40,000. Year 3, I'm getting 20,000. That is my payback period. Just what comes to your mind? You look at this example. Any idea of payback period? Payback. Shant, Rama, Almas. Any idea on payback period? Payback. Right. So payback means what we have invested. That's correct. What you have invested when you purchase a machinery, to recover your investment, how many years will it take? Now tell me the payback period. Our investment is 100. To recover my investment of 100,000, how many years will it take? 2 years. First year 60,000, second year 40,000, 2 years. Right? So that is payback period. Very simple. Let's say my investment is 100,000. Year 1, I'm receiving 50,000. So remember in payback period, we don't consider the returns after the payback period. So that's a disadvantage, okay? Now year 1, my investment is 100,000. Year 1, I'm getting 50,000. Year 2, I'm getting 100,000. Year 3 also 50,000. Year 3, anyway, we don't consider. What is my payback period? No, it won't be 2 years, no, because 2 years I will get 150. No, it won't be 2.5, Shima. It's less than 2 years. Exactly how many years and months? Nisha? Shafa? I didn't get any response from you. Afra? Yes. Now in year 1, we are getting 50, right? Year 1, we are getting 50. So to recover your investment, how much do you need? You need only 50. But in year 2, you are getting 100, right? So to get 50, 100 is for 12 months now. You are getting 100 for 12 months. So if you want to get 50, 100 is for 12 months. So if you want to get 50,000, then how many months? If you want to get 50, how many months? So what do? Cross and multiply. So this method we are using everywhere, cross multiplication. 50 over 100 into 12. So this is 6 months. Right? Yeah. Six months. Right? 100 is for 12 months, 50 is for 6 months. Right? Is it clear? Yes, we assume that every month you are getting equal amount. Right. Let me take another example. Okay. Let me take another example. This is also a common question, right? Every time you have this. Investment is 500,000. Investment is 500,000. Year 1, I'm receiving 200,000. Year 2, I'm receiving another 200,000. Year 3, I'm receiving 200, 400, 100,000. 400,000. What is the payback period? Years and Zara, how much is the answer? Right. So 500, 500, 500,000, first year 200, second year 200. Right. So altogether, you receive 400,000 in 2 years. Then you need another 100,000. Right. Year 1 and 2, 200, 200. Year 3, you get 400,000. Right. So 400,000 is for 12 months. You need only 100,000. So 100,000, how many months? Cross multiplication. 100 over 400 into 12 months. So it's how many months? It's 3 months. So it will take 2 years and 3 months. So I hope now it's clear. Now let's write the note. Very simple. Okay. Understand the concept, then easily you can get marks. Yes, there is a question. We calculate the period. So you have to give the answer years and months. That's correct. So let's write that under payback period. What is payback period? Payback period means the period which take to pay back the cash or the cost affiliated with the project, identified as the payback period which takes to pay back the cash of cost which is affiliated with the project is called payback period. Example one. Example two. Yes, example was number one. So this example two. Affiliated means connected. Another term, if we say this definition in the just guide, another term. So a simple definition also will write this is the amount. Payback period refers to the amount of time, or we can refers to the period it takes to recover the cost of investment. How many years and months it takes to recover the cost of investment. Let's do example 2. Company expects to invest on an investment which has a value of 250,000. Expected annual cash flows are 50,000 every year. Calculate the payback period. So this example is example 2 is future cash flows are equal in every period. So if the future cash flows are equal to every period, there is a simple way to calculate it. I'll give that formula also. How many? What is the answer? Tell me. Simple. How much, Shafa? It's fine. Yes. So it's simple. You can use this equation if the amount is equal every year. If the amount is equal to every year, we can use this equation. Payback period equals initial investment divided by annual net cash flow. So initial investment is 250,000 divided by annual cash flow is 50,000. Answer is 5 years. If the future net cash flow is equal, you can directly divide by annual net cash flow. Then let's do example 3. Right? So let me do example 3. Example 3. Future net cash flows are not equal. So here's the example. A company expects to purchase 2 machines. The net cash flows related to these 2 machines are as follows. Purchasing price of both the machine is 50,000. Then the net cash flows are given. Machinery A and machinery B. Decide on which machine to be purchased by calculating payback period. Investment is same, 50,000. Wait, not 50,000, it should be not 50,000, it should be 300,000. So based on the payback period, you have to decide which machine we should purchase. Cost of the machine is 300,000. It was a mistake. What is the answer? Machine A, 3 years, 10 months. So which machine will you purchase? Are you purchasing machinery A or machinery B based on the payback period? Both the names are machinery. That's a mistake. The second one should be machinery B. Okay. This is machinery B. So first machine should take the timeline. First year it's 80. Second year 80. Third year 70. So 80, 80, 160. 160 plus 70. 230. That accumulated. So in year 4, 90. Right? So 3 years, and to make it 300, you need only 70. 70 more in the 4th year. So year 4, we are getting 90,000 for 12 months. So how many months will it take to get 70,000? So cross multiplication, 70 over 90 into 12. 70 over 90 into 20 is how much? 70 over 90 into 12. 9.3 months. So it's 9.3 months. You can take 10 months. That is also fine. 9.3. 9.3 or 10 months also fine. Yeah. Okay, so machine A, 3 years and three years and 10 months. This machine A. Machine B, 80 plus 70 plus 90 plus 50. 90. So it's 4 years. So it takes 4 years and another 10,000. 10,000 is required. In 5th year, you are getting 40,000. So 4 years and how many months? 40,000 is for 12 months. 10,000 is for 3 months, right? 10,000 is for 3 months. Yes, correct. So which machine do you take? You take machine A. Because if you purchase machine A, your investment will be recovered faster. If you purchase machine A, because of the less payback period. Right answer. A machinery is suitable to be purchased due to the less payback period. Payback period is less. You can't take 9, it should be 9.3. 3 years and 9.3. So it's not 9. You have to take 1 extra. Don't take 9. Either you write 9.3 or 10. So investment appraisal, payback period. Are you all okay with investment rate of return and the payback period? Now I am moving to the net present value. Now, net present value means this comes when it in the when there is a when we consider the time value of money. Now here I was explaining first two methods, the payback period and investment rate of return. We don't consider the time value of money. But you know, when it comes to the investment, it is very important for us to uh, consider the time value of money. So what is time value of money? Time value means, now if you take today's 100 rupee, today you have 100, but after 1 year, the value of this 100 is not same. Because if you keep this in a savings account, and if you are getting 10% discount, 10% interest, the value is 110 because you are getting 10% interest. So if you are getting 110 after 1 year, today's value is 100 because of this interest rate. So we call this 10% as discount factor. This 10% is called as discount factor. Right. So let's I'll explain the example from this. There is a question. Can you explain again? Yes, I'll explain that again. This is yes, inflation and many other reasons will affect this. Now you know, inflation is one reason. Now let's say you have 1,000 rupees. So this is in year 2000. Year 2000. Have you all born in 2000? Yes. Yes. Have you all born in 2000? Yes or no? Okay. Then maybe 2002. Okay. So in year 2000, let's say your father had 1,000. So he goes to the supermarket and he buys some goods. In 2021, he goes with the same 1,000. Can he buy the same goods? Yes or no? No. So it never happens. Why? Because the value of the rupee has decreased because of the inflation, because of the exchange rate, and all other factors. The cost is increasing, uh, the cost of manufacturing cost is increasing, the material cost, the labor cost, right? So everything increasing. So if you take the value of money, it is value of the money is decreasing. And when it comes to the investment appraisal and the financials, what we consider is the other side of this. We consider the other side. What is the other side? Yeah, purchasing power will decrease. The other side of this is, let's say you had 1,000. Maybe your father, or year 2000, your father had 100,000 cash, right? Not 2000. Let's take it 1980. Maybe your grandfather had 100,000 rupees. Okay. 1980. He had 100,000. What he does was he keep it in a box. Now you are in 2021. You find this 100,000. What is the use? In 1980, for 100,000, what can you do? You can buy a land, you can buy vehicles, you can do a lot of things. But now for 100,000, what can you do? You can't do anything much. And if he invest it, at least in a bank, he will get an interest. If he buy a land, the land value will increase, right? So 100,000 in 80, maybe if we deposit in a bank and get 10% discount, today the value will be more than 100,000. It may be maybe 500, 600, 1 million. Right? So keeping cash is not worth. You have to invest that. So this is the point that we mainly consider under NPV calculation. Right? Simply remember, we don't need anything here. Just understand the basic concept. If you have money today, if you invest that money in a bank, you get a interest, right? So today's 100,000, after 1 year, it is more than 100,000. Or in the other way, if you are getting 100,000 after 1 year, Today value is less than 100,000. That's the basic concept of time value of money. So let's do an example. NPV, net present value. Write the heading net present value. Give me a minute. Net present value. Number 3. Net present. So what is net present? I'll explain example. Right? Example. So most of the questions will be based on the NPV. Okay? Most of the questions will be based on the NPV. Let me explain from the example itself. Example 4, right? Example 4. Let me take basic question. Number 1. So this is an example from the teacher slide. Calculate the present values of following cash flows based on 10% discounting factor. Normally the discount factor will be given to you. Year 1, year 2, year 3 and year 4. 4 years discount factor will be given to you. Okay, so calculating discount factor is very simple. So let's calculate year discount factor 10%. Net cash flow 100%. Year 1, 2, 3, 4. Let's take the net cash flow after that discount. Net cash flow is 10,000. Year 1. Year 2, it's 25,000. Year 3, 15,000. Year 4, 10,000. Discount factor 0.909, 0.826, 0.751, 0.683. Present value equals cash flow into the discount factor. That's how you calculate cash flow into the discount factor. So 10,000 into 909 is 9,090. Multiply all this, you get the final answer. This is called net present value. You can use a basic calculator, right? They will provide the discount factor. You don't need to find, the discount factor will be given. Therefore, it's very simple. NPV means you need to add all the present values. If you add all the present values, you get the NPV. If you are getting 10,000 after 1 year, today's value is only 9,090. If you are getting 25,000 after 2 years, the value today is 20,650. And if you are getting 15,000 after 3 years, today's value is 11,261. 10,000 means it's only 6,830. This is how you get the present value, and total of this is the total present value. And if you have an investment, investment will be considered. Right? So here there is no investment, it's only present value given and it's 47,835. So let's say here the investment is if the investment is 60,000, then the NPV is how much? Equals to 60,000 minus 47, 8, 12,000. So if the NPV is positive, we will take up the project. If the NPV is negative, we don't take the project. So let's do one more question on this. And you can have that as a note. If the NPV is positive, project will be accepted. If the NPV is negative, the project will be rejected. So always NPV should have a positive 10,000. Why you deduct from the investment the present value? This is the total present value. Actually, this is the total present value. When you compare with the investment only, it will be net present value. So investment is what you pay. This is the cash you receive. Okay. I'll give you all another example. I want you all to find out the NPV. Example 5. They will give the investment amount. Project with a 3-year life and a cost of 100,000 generates revenue of 25,000 in year 1, 45,000 in year 2, 65,000 in year 3. The discount rate is 8%. This is the NPV of the project. You will get the discount factor, right? So these are the format. You can take either 3 decimals or 4 decimals. Normally in our A-level, we take 3 decimals, 0.926. You know, complete this. Year zero means the investment. Discount factor for year zero is always 1. What is the answer? Cash flow is initially it's minus 100,000. That's the initial investment. Positive negative is now positive means NPV positive means if you invest 100,000, your return is more than 100,000. So that's favorable benefit for you. If you invest 100,000, if you are getting more than 100,000, then you will accept. If you are getting less than 100,000, no point of investing on this project. That is positive negative. Revenue year 1 20,000, 25,000, year 45,000, year 2 65. So it's not a minus answer, it's a positive answer. The project will be accepted. Yes. NPV is so income minus expense. The investment is 100. Our income or the return is 130. But how do you calculate net return? Cash inflow minus cash outflow. There is a question. How do we calculate? Why do we deduct and add? Cash inflow is the addition of these three. 113, 325. 113, 325. Our outflow investment is 100,000. So that's how we got 13,325. Okay, invest inflow minus outflow. You are getting a profit. That is called NPV. Let's do one more question today. You have two machines, two investments, right? Example 6. Saroma Garment Factory expects to purchase a new machine in future and its cost is 150,000. Expected future cash inflow and outflow of this machine. Cash inflow and outflow is given. Two machines, it's only one. Cash inflow outflow is given. Investment is 150,000. Discount factor is given. Requirement. Calculate the NPV. Purchasing decision based on NPV. Okay, can you all do this? Example 6. This one, I'll do year 0, 1, 2, 3, 4. Then we take cash inflow, cash outflow, and you have to calculate the net cash flow. So always you have to calculate the net cash flow. Then the discount. Right. I'll show the first one. Year 0, we invest 150,000. Year 1, cash inflow is 160,000. Cash outflow is 100,000. So net cash flow is 60,000. Year 1 is it's 150,000 minus. Discount factor 890.797. When you complete this, inflow means what we receive. Year 1, what we receive. Cash receipt, inflow. Outflow means cash we pay. There is a doubt, but what is cash inflow and what is outflow? Inflow means what we receive. Outflow means what we pay. How much is the right? What is the answer? Okay, I got one answer 89, 490, 52, 210. How about others? Year 2 inflow is 180,000. Outflow is 110,000. 150, 160, right? So what is the answer? The NPV 39, 4. Since the NPV is positive, project will be accepted. So think positive, be accept. Okay, so those are the main parts. So in the next class, I will do the past papers of the NPD and the investment person.